I've never had a salary. I've never had a bonus. I've never had anything. I believe that if the company does well, then I will do well. If the company's not doing well, then I won't. When I was signing off on the $37 million wire transfer, I was like, I'm now doing this for life. If I own under 10% of Maropost, I would never come to work. It wouldn't make any sense. Like the amount of suffering and pain that we have to go through. I just don't know that there'd be much motivation or drive if that was the case. I don't aspire to be the CEO of a public company.
Today on Billions, I'm sitting down with Ross Andrew Paquette, the CEO who broke every Silicon Valley rule. He bought out his investor before building a $1.7 billion empire. He founded Maropost in 2011, and by 2016, it ranked number 7 on the Profit 500 as one of Canada's fastest growing companies. Ross, thanks a lot for being here.
Yeah, thanks for having me.
In the early days, like when you co-founded Maropost, I think it was around like 2011. Initially, you had like kind of a lifestyle business. I think you wanted to make like 500K a year, supporting like 10 clients. When exactly did you realize that this could actually be something much bigger?
Yeah, to be honest with you, as you said, that was the plan from the get-go. So it was to just provide customers with a better service, but just, as you said, a bit of a lifestyle business. Between 2015 and 2017, we didn't change our dynamic. We had maybe 6 or 7 people within the company, but in about 28 months, we went from 300,000 in revenue to about 27 million in revenue. And we weren't doing anything different. We were still selling customers. We were just continuing to develop the product. And I think that, well, that wasn't the plan. It's just the, kind of the functionality or the platform that we had built at the time just caught up with what the market really needed. And, that just kind of exploded, as you were saying earlier.
Insane. And when exactly was the time you actually took funding?
It was late 2016. Yeah.
Okay.
But it was an all secondary round. So we really just took the money, put it into a trading account. We can get into some of the details of that, but I think it was fortuitous for everyone because we were just I was just so far away from the kind of funding process. Like I had no experience in that. I was just trying to build a great business, and that doesn't necessarily or doesn't always align with sort of the VCP model that exists out there.
What do you feel is like the biggest difference?
I think profitability is the big thing. So back then we were about 75% EBITDA or free cash flow, which is, I understand that is crazy. No matter what, I mean, most companies, that's gross margin, not their net. So I think that was the big differentiator. And, back then, now of course, right, when we're talking about sort of typical B2B SaaS companies, people are looking for that profitability. But there just aren't very many companies who've ever even achieved, any sort of positivity from that side of things. So when I think of the 2016 timeframe, that was all about growth at all costs. Let's spend 50 million, spend 100 million, let's build. Some of the businesses obviously that have been extremely successful to date come to mind there. But at the same time, a lot of failures also. And it's a good 99% of the companies that are failing out there that, took that model or took that approach.
Yeah, definitely. And when it comes like to the EBITDA margin, was it like this from design, like by design from the beginning, or did you see it like increasing over time? Because going to like 70% EBITDA margin at some point is just insane. And
it just happened. That wasn't really the goal. I mean, there was no percentage goal. The goal was, of course, to have a profitable business. Like I've never had a salary. I've never had a bonus. I've never had anything. I believe that if the company does well, then I will do well. If the company's not doing well, then I won't, unfortunately. And that's the, kind of the risk reward that we take as founders. But that was, I think we were just at an extreme time where the revenue was growing so much and there was just so few people in the company, right? I was the VP of marketing, or I was the, chief sales officer. I was the head of finance and so on. And to be honest with you, that was my favorite time in building the business. Every day my partner at the time, she kind of said, you can work 18 hours a day if you want, because clearly you love it. Like you just wake up, you go to your desk and you're smiling, for most of the day. But you have to take me out for dinner every time you sign a new customer. Well, the problem was we were signing new customers like every day or every second day. We created this really great, environment, really great experience. And we continued to hire these very, sort of young and hungry individuals into the business at that time as well. So the energy was always very, very strong.
Yeah, it reminds me, of that photo. I don't know if you've seen it, but it's a guy is it just started his company, and on the
Yeah.
website it's written like team members, and then it's a photo of him, but in different like outfits and
Yeah,
different like
I
haircuts.
got see that. For
Yeah,
different roles, you mean?
yeah,
Yeah,
exactly. Yeah,
exactly.
yeah.
Uh,
And you were talking about like hiring and like hiring like very like young and hungry people. Like how exactly like did you spot them, and what was kind of like did that evolve over time? Because now you're like a billion-dollar company. So what was kind of the shift?
yeah. It certainly did evolve, not in a positive way though. I would say our number one challenge over the past 5 years, frankly, 4 or 5 years, has been hiring. And I think every time that we looked for somebody with, the experience of like scaling a business or more just simply their time in the market, right? They've been 10 years as a CFO or 10 years as a CRO or something like that. Those people have all really failed in terms of the experience at Maropost, which is very unfortunate. But we've really just recently, I would say in the last 9 months, come back to that model of hiring the young and hungry, and people with more of that sort of modern mindset. Because I think it's just the energy you want to have. I mean, even some of the founders and executives that I'm close with, you know. When they're being honest, they're like, you know what? I'm 50. When I hear the story of Maropost or company XYZ that's growing fast, I get all excited and I'm like, I'm gonna work like I was 25 or when I was 30 again. That is just not the reality, right? Like even for me, I'm 42 now, and some days are more difficult than others. So we've noticed a huge shift in kind of moving back to that. And also, I do think the industry is going through a change right now where a lot of, again, the very successful executives out there, right? They're wanting to retire or semi-retire or become advisors or become board members and so on. And so we've got this bit of a gap where a lot of the up and coming VPs and even senior directors and so on. Those are the people that we're really looking at, and those are the people that have been extremely successful at Maropost. Again, in just the last 9 months, like we have actually accomplished more in the last 9 months than we have in the last 10 years. Which
Insane.
you want to find a heavy cocktail right now. This,
I've got more or less like the same experience. I mean, we're like smaller company, like around 160 people, but
yeah,
what I found that it's hard, like to find the intensity that you can have in the early days as your company scale.
100%.
And I would say that actually the people I've hired who had like the best track record on paper, like
Yeah,
going
same.
from great logo to another great logo,
Salesforce and
like yeah,
Shopify and
exactly.
Oracle. Yeah, and yeah,
It wasn't a fit at all.
no, I
um,
totally understand.
and like I want to go back to the story with I think it was Elephant and Highland Europe.
Yeah,
So like two funds who basically like you did, I think it was a secondary deal with them
yeah.
in 2016, and then in 2019 you actually like kicked them
Bob,
out or
yeah,
or bought them
yeah,
out.
yeah.
Can you maybe like walk us through like the whole process? Like how did that happen? Like how do you decide like to actually buy out
Yeah,
your yeah.
I think that they were amazing people, is what I will say. I think if we had gone with like a Summit or Insight or TA, all great firms, but I think that would have led to like a lot of lawsuits, and it would have like demolished the company. And I think that we read from time to time about these stories, founders getting kicked out and so on, and that wouldn't have happened here, but it would have just turned into a fight. And because of those differing philosophies, or the lack of philosophical alignment, is what I would say. And so when it got to that stage, it was just kind of like why I say like they were good about it. They were like, let's just find a way for like to get most of our capital back, and we'll part ways, and everybody move forward. You go build Maropost, and we'll go invest in other companies, and everybody would win. Because I think when you again see a lot of those examples, right, it's like they also knew what I had done, not I had done, but like knew what we did with the capital, and that it was just sitting there and generating growth on its own. So it kind of worked out as well. And I don't know if I should share this part, but we took the money, we invested it over 3 years, and we made about 60% of return on that. So not only did we just return the money that they had given us, we ended up with 60. So it was like, so nobody really lost anything, I guess, was the summary.
So you could buy them out at like 1x of what they invested, or
Basically, it was like that. Yeah. Yeah.
okay. So how exactly do you come and discuss these kind of terms? Because
Yeah, it wasn't in a positive way. I mean, we had, and it never is, right? But it was, like I said, it was such a unique example. They knew that, okay, there is an opportunity to, and on the other side, they could have bought me out, right? But at the same time, where I was at that stage, and still would have been today, is that I was like, how am I going to turn over my customers, right? Who I like, most of which I've sold to. Some of these people have become quite close friends. I'm like, if I sell the company off to a different group and they bring in a professional CEO, like there's a highly likely chance that this is going to go sideways, and nobody knew who they were, right? But of course, everybody within the business and our customers knew who I was. So where I'm going with that was, those were the two options. But then we, of course, had an independent board member, and he sort of facilitated this discussion. So he was, really just said, hey, do you guys want to just separate? And maybe Ross, you figure out what you want to return, and you guys figure out if that's, good enough for you. And like I said, everybody just kind of goes on their merry way. So this was like the best situation that could have occurred for everybody. Like
yeah, I mean, it's insane. If
Yeah.
you made like 60%, on top of what they
Yeah.
what
Yeah.
you got, and
And
bought
they
them back
had the
for
investment, or effectively the share purchase, right? There were more partners than investors, given it's a secondary.
yeah.
It was about 50 million Canadian dollars, or 37 million US dollars, like not a small amount of money. And the one thing I will add is, I think I didn't think about it at the time, but I discuss it quite frequently these days, is when I was cutting that, it wasn't a check, it was a wire transfer. When I was signing off on the $37 million wire transfer, I was like, I'm now doing this for life. Like, there's not going to be anything else but Maropost. That is a unique scenario. I've not come across anybody who's had to return 37 million. It's a lot of zeros.
No. We did a $30 million secondary in 2021, and
Yeah.
I don't think they would like if we
You don't
just
think you want to give it
return.
back?
No.
Yeah, exactly. Yeah.
But what was like what was the driver for you? Because typically, like right now in my company, like I have obviously like a board every quarter with Growth Expedition, like a secondary firm.
Yep.
And I mean, like they are partner, they see the business growing, like they trust us, etc. And I'm wondering, like, what's the driver for you when you've done secondary to actually like basically like buy them out, and was it like the control of the company you were like interested in, or you just
No, it was just there again. It was this is all public information. So like they had purchased 25%. I still had 75%. So it wasn't about control by any means. In that example, it was really just, again, that alignment that we didn't have. So it's like I didn't feel like there would be much value in continuing to have the types of meetings that we were having. They obviously didn't feel like this was the type of business that they wanted to be invested in. And so,
okay.
yeah, I would say like that's kind of the core element. I mean, where we have been significantly more successful in a period without a board entirely, right? And that doesn't mean that there aren't people out there that are, extremely valuable to the business and can provide a lot of insight and so on. And now, like today, we have an advisory board. We have a gentleman who built Shopify Plus. We have a gentleman who built one of the largest marketplaces in North America. Another gentleman who owns a B2B SaaS sales video company, I guess here. And so they are extremely valuable in terms of, growth in the e-commerce space, in terms of growth from a marketplace and technology space, in terms of, growth and maturity from a B2B SaaS perspective. So we get a lot of that value now in a different format that is significantly more valuable than anything any professional investor board member can provide. I mean, I think this is the same reason why you see most investment firms, they've got, CEO or entrepreneur in residence, who are past founders typically, they're bringing them in because they're like, we really don't know what to tell you, at the end of the day. But here's somebody who can help you because they built something from 0 to 100 or 0 to 500 or whatever it may be. So
nice.
for me, this is a much more beneficial strategy. The 37 million was great, but this side is more valuable in the long term.
And how exactly do you build like such boards? Do you just outreach people? Do you get intros? Like, do you Yeah.
Yeah, actually, I mean, it's usually more in like at this stage, right? I've been at this for 17 years or so, in its entirety. It's usually just, yeah, friends, networks, and so on. And basically looking for people with, again, coming back to that philosophical alignment with that same type of alignment. Like, I only work well with people who have like a strong obsession around customers, whether they're an employee or a founder is irrelevant. And a strong sense of urgency. Actually, probably an extreme sense of urgency would be the best way. So as soon as I find that profile in an individual, and you can usually get that just by the way they speak, how fast they talk, their movement between topics and so on. It's rare, but when you find them, they're extremely helpful.
Nice. And did you like, do you like actually pay them or give like a
Yeah,
percentage or stock
both.
options?
Yeah,
Like both? Okay.
yeah, yeah.
Can you like share the range or is it,
Uh, yeah. I mean, I think you can like you can chat GBT it. I mean, it's usually in like the 50 to 100K cash per year range. Sometimes there's a meeting fee,
okay.
and then from an equity standpoint, I think it's in like the 0.0% from that
Okay.
perspective as typical. But it's a standard range. Yeah,
Okay. Super
yeah.
nice. And going back like on the storyline, like in 2022, you did like another like secondary share sale. This time
No,
it
so
was a
yeah, so we that was a unique scenario.
yeah.
We didn't do a secondary share sale per se. I know it shows up on Crunchbase, but basically, like everybody else in the space, valuations started to get out of control. I was watching the business grow. Revenue was amazing. Our customers were doing well. We had launched new products. We were starting to cross sell these products as well. And, so we went out to our network because over the years, of course, I've probably got 1,000 emails or plus of people wanting to do, get into the company in some form. So we started allowing people to do that. And that's where that amount comes from. So there was about 280 individual parties, both firms and individuals, that wanted to come in. We had to stop at 135 because it was just taking so much of my time. Like it was so much paperwork and signatures and like responding to questions and that. So
Mm.
yeah, so we went through that process, but it's not, there's no share ownership. It's set up as a effectively we repurposed a safe agreement or structure to work as if it's almost like they're buying options. So you
Nice.
avoid any of the friction of having people who actually own shares. And, of course, we give them quarterly updates and all the usual stuff. But at the same time, they're not in the business until we convert into, a public company, which is our ultimate goal.
So basically, like for them, the liquidity event will happen once
Correct.
you IPO. Is that correct?
Yeah,
Okay.
exactly. Yeah.
And do you have like a timeline goal for the IPO? Like how exactly
Yeah,
do
it would
you
have been
like prepare
now,
for
but I
it?
would say a lot has changed over the last few years. But I'd say we have probably a 3 to 4 year horizon still. Once we get to around 500 million in revenue, that's where we really need to be, and we're about
Okay.
10%. So we've got some work to do.
Okay.
Yeah,
Nice. No, that's cool. And yeah, when it comes to like IPO and how exactly do you like think of it? Like, because your company needs to be structured in a very different way. You have like so many like filing that you must do. Like it's
yeah,
quite complex and it becomes like a very different company. I'm
for
curious
sure.
because like from what you said to me like earlier, I know what you prefer, is like, or at least what you love the most, where the early days, the early grind, when you can
Yeah,
work 18
yeah. It's
hours and
very.
you,
I don't
yeah,
aspire to be the CEO of a public company. Like that's
okay,
not the reason for it.
okay,
And there's a very unique strategy that has never been done before, which is pretty typical in Maropost form, I guess. Uh, but like anything, there's a checklist, right, to going public, converting your financials, as you said, different types of filings, have a consistent reporting package over the last 2 or 3 or even 4 years in some cases. But I don't think anybody, including myself especially, looks at that as a challenge, so much so that really a lot of that work, like 95% of it, comes down to the CFO outside of actually going out and selling and pitching and so on the company. But for us, like I really want to, what I was saying before, do something. It's not about doing it different for the sake of it. I don't have an interest in going public in the U.S. I guess
okay,
I watched a number of friends have short seller reports come out that totally decimate the share price. And I've just seen them. They look completely defeated. Like, I want to enjoy my job, right? As we were discussing earlier. And it's hard enough to build a scaling business, never mind doing it when you've got, people working against you in the example I just provided. And so the plan actually at Maropost is to go public in a Canada-Australia dual listing, which coincidentally, has happened, but it's happened in like the mining space, which is clearly not the same as ours. But it would create a very unique opportunity because Australia, if I'm not mistaken, has very limited or no tech companies in their ASX 100 as an example. And Canada, I think has maybe 15 or so from that perspective. So you've got, it's never going to be the same as the US in terms of the investor pool, but you've got a large amount of investors in both regions. In one case, no tech opportunities. So you automatically kind of end up in this very beneficial situation where, hey, we're limited to what we can even buy. Well, Maropost is there, profitable company, growing, seems like a very exciting opportunity. And then you avoid, again, as those things I mentioned before, short seller reports, endless investor lawsuits, and so on, that typically come along with the US listing. So pros and cons.
Yeah, and I think it gives like, you have like the pros of having something where you can have like liquidity and people can invest in it, and it's quite nice. But at the same time, you don't have like the same amount maybe of pressure. But
100%, yeah.
How exactly would that work actually? Like, because if you own like, let's say 100% of the company minus like the safe, and you go public, like
that's actually a big part of the rationale as well. I don't personally plan to sell that much as part of that, let's call it liquidity event.
Okay.
I don't think I would ever drop below 75% ownership in the company. Maybe someday way down the line, but the goal is to maintain, the vision and the direction and the goals of the business. And, I'm certain at that stage I will have, a very strong operating partner within the business as well, beyond even the ones I have already. I don't think that, is so much of a challenge is what I'm getting at.
Okay, interesting. And do you know like many companies where the founder actually IPO'd with, like a lot of ownership?
No, it's never happened before. Never. I think the largest I've ever found was Atlassian, where the two founders owned about 75%.
Okay, nice.
So that is 37.5 each. I think they were the largest. There's a document somewhere, that I've seen before. I'm sure we could find that shows all of those tiers for every, but you see, I mean, some of the examples, I mean, of course, I'm not comparing Maropost to Oracle, but, Larry Ellison's net worth, is heavily tied to his Oracle ownership. And if I'm not mistaken, it's like 45%. So like, that's pretty crazy. But you get there, of course, by not selling off, like of course, I'm sure you do as well. Like we both have friends that probably own 7% of their company, because the first round they gave up 20%, for a few $1 million that they used to build the business. And then the next round was another 20. And, all of a sudden they're in this like sub 10% category. And for me, I find that, going back to our conversation earlier around, raising capital and being a part of that sort of strategy, I just don't see the point of it, I guess is what I'm getting at.
Yeah, and I think like to build up on what you say, like with some of our common friends who like raised up to Series D, it's not so much like owning, let's say, like 7 or 8%. It's also that the preference stack is pretty shit for them, because they have common, and then you have like layers of for each series, like a new preference coming on top of the other. So
for sure,
we
where this comes up a lot. So almost every day or every couple days, we're having conversations either with our recruitment team or with with people we're hiring into the business, and that conversation the preference bit comes up in every discussion. Because in a lot of the recruiters, they even say that, like, we don't think you understand, like they're saying this to me, how strong the opportunity is here. Because let's say it's Maropost versus company XYZ, and company XYZ has raised 400 million. They're like, that 400 million has to be paid back first before there's any payout. And that's on the basis that you even sell for 400 million or more, or 300, whatever the number is, doesn't matter. Whereas at Maropost, it's like, this actually is your direct equity. Once you've vested and once you purchase, you will receive dollar for dollar on an exit. So it's a huge value add actually for your employees and for your staff to maintain that.
Yeah,
and yourself,
definitely.
of course, as well. Yeah.
And how exactly did you split kind of the stock options that you give like to your team?
Yeah. So everybody in the company has options. And actually, it's kind of a funny question because, for a long time, it was just kind of like one to one, maybe not at the a level of, say, just like a sales rep or a support rep, or more of the frontline staff in the company. Um, but now we just have a tiered structure. So there's maybe like 15 tiers, and wherever people fall in, that's the level that they get in terms of the option. So it keeps it very consistent across the team. And of course, as people are promoted, they receive additional grants and so on as well. But the structure of having those tiers really helps, in my opinion.
Yeah, I'm really curious because it's not something we've done like in a super like we have some tiers, but it's not
Mhm.
very, I would say, well
It's not
like laid
specific
out.
enough.
Yeah.
Yeah. Yeah. Ours has
So
like every title within the company. So if they're
okay.
like at C level, obviously senior VP, VP, director, all the way down to the bottom. And every role that we have like has coverage. So it's not like somebody's guessing between the two. And I mean, what's great about it is like if you've got two senior directors, and they have a beer one night or have a drink together and they start talking about what options they have, one doesn't find out that they've got
Yeah.
half of what the other person. And so it
Yeah.
just keeps it consistent. Yeah.
No, that's a good way of doing things. And no matter like the department, basically like a director from one department and another
Yeah.
one, they would
Same.
have like the same. Okay,
Yeah.
okay, interesting.
Exactly.
No, that's cool. Um, and I think like I remember, I think you wrote like an article. I think the title was "This is why your business should avoid taking investor money."
That sounds like
And
something it would read. It's probably a few of those. Yeah.
so
Yeah.
if you had to give like why do you think like a business should take VC money, and why do you think a business
I don't think
shouldn't?
they should ever. I'm pretty
Ever?
adamant
Okay,
about that.
okay, okay.
Not ever, like not never ever, but I just think that going back to that example we were discussing earlier, in all, like I'm trying to think of there's of course there's always edge cases, but like if I own under 10% of Maropost, I would never come to work. It wouldn't make any sense. Like the amount of suffering and pain that we have to go through, right? I'm probably not getting a lot of sympathy, or we probably wouldn't get a lot of sympathy, but in the general market. But from a founder perspective, like we know how much work it takes. And I just don't know that there'd be much motivation or drive if that was the case. And so there's another gentleman, actually, I don't know if you know him, Adam Robinson. He owns
Yeah, retention.com and
yeah.
RB2B. Yeah. I
Yeah,
know
so
them.
my sort of right hand woman, circa 8 or 9 years ago at Maropost, she actually is one of the co-founders there, along with Adam as well, and he speaks a lot to just this overall challenge that we're getting into as well. So whether it's the ownership stake that you end up in with each dilution that goes through that process, whether it's the kind of the typical challenges that investors bring to the table, right? Like when I was younger, circa 2016, they would have these like presentations. Oh, if we hire these people and we build this process and we spend $5 million, then like all this magic will happen. Well, of course we spent the 5 million and then the magic didn't happen. And so I think that's where like it becomes a sort of cascading effect. Then you, as the founder, who ultimately just wants the business to succeed, ends up in a position where you're just like one, doing investor management, and two, relying on the rest of your team to really make things happen. And at the end of the day, I mean, what's that, the say or the article that came out around this founder mode? Like ultimately, call it whatever you want, but like you're the founder of the business. Like if you can't sell your product, if you can't market your product, if you can't manage ultimately like the product goals of the business, it's going to be harder to succeed in all those environments. Of course, you can always throw enough money at it. If there's a good enough idea or a good enough product market fit, then it's likely going to work out. But I mean, I'm sure Attentive and Klaviyo, like they're different success stories, I would say, but they've raised $1 billion. $1
Yeah, it's
billion.
insane.
Like, if somebody gave me $1 billion, like I don't even know what would happen. I would probably take 50 million from Maropost and spend 950 on, like, I don't know, curing cancer for the love of God. But the point I'm getting at is like that's that environment, right? Where of course you were going to be successful again if the product market fit was strong, if somebody gave you $1 billion.
Yeah.
And so I just don't think that is a scalable model, because of course, again, it only works in like 1 out of every 1,000, or frankly 1 out of every 10,000 probably is more likely.
Yeah. No,
Yeah.
I agree. And Are you investing in startups from time to time or not at all as an
We
angel?
have Maropost
Yeah.
Ventures as well.
Okay.
Actually, we were an investor in Grok, if you're familiar with them. That was just
Yeah.
acquired by NVIDIA for 20
I
billion or so.
invested in there too.
Oh, you did? Good,
Yeah,
good.
yeah.
Yeah.
I was happy with that news.
Yeah, for sure. Same, same.
Yeah.
So that's, there's, I've definitely scaled that back because I just don't think Maropost is big enough for me to be spending any of my excess time assisting other businesses. But,
Yeah.
I'm sure that'll come back in the future. And I think it relates as well to sort of the long-term planning of Maropost, where, of course, the core business is always the first and foremost, but then we have Maropost Ventures and then we have Maropost Cares, which is our nonprofit. So, it sets up that, like, in 10 years from now, maybe I'll spend a lot more of my time in the other two areas than I do, on the day-to-day of Maropost itself.
Yeah, that's really cool. And talking about like growth and scale, like some of the thing we see a lot, like and maybe a bit less on SaaS businesses, but you've done a lot of like acquisition and build up.
Yeah, we have. Yeah.
And I
More
think you
than
made
most others. Yeah, that's for
yeah,
sure.
exactly. So can you like walk us through like the strategy and how
Yeah,
you approached it?
for sure. So for us, this is kind of a longer story, but back in 2015, it became very obvious, as we were talking before, right, going from 300,000 to 27 million in revenue. But it became very obvious at that point that, like, this 30 million range was sort of like the limit that, Ross himself, as like relatively one individual, could build and grow the company. But that one of the other variables was that we had to become a multi-product solution. And so, um, like at the time we would compete with, I mean, everybody, but Salesforce Marketing Cloud, or all the marketing clouds, ExactTarget, Responsis. There was Bronto back then, ListTrack, and so on. But we would take a customer from them, they would take one from us, but it really slowed the growth. And so the idea became very quickly like to become an e-commerce marketing automation and help desk solution. So, from a circular customer centric approach, somebody would come in, they'd buy Marketing Cloud, we would sell them like e-com, and then of course they would need help desk solution as well. And so that would really round out a strong value set from a customer standpoint. Long story short, and leaving out sort of like that investor period where not so much happened, or basically nothing happened from a product growth and product development standpoint. We acquired our first company, which was Nido, called Nido, out of Australia, and they were an e-commerce and retail solution. They also do B2B. It's still a very valuable platform. We have over 2,000 customers, 2,400 customers, I think, still utilizing that system. More and more of them are moving over to the Maropost platform, but that's another component to it. But really, like, we just lacked the experience in the e-com and retail space. We were struggling with multi-currency, multi-store, basically anything with the word multi in it at the time, on that front. And so acquiring that business really, really helped us move the ball forward. It was an extremely difficult acquisition from a culture perspective. I would not want to relive that year, I'll tell you that much. We actually acquired another business in Australia to stabilize that business. The second one was Retail Express, that was a retail solution or point of sale solution as well. An amazing founder there. I really, really enjoyed working with him. He's since moved on, but we're very, very close. So that's definitely a success story there. And then we actually acquired a company out of Sweden, so where I coincidentally lived part of the time, that was a partner of Nido that provided search and merchandising functionality, or still does, sorry, I should say, called Findify. And so those were sort of like the main acquisitions that we made. And part of our strategy moving forward is still to make acquisitions. There's, a number of benefits from a customer acquisition standpoint, from a tax benefit standpoint is a big one as well. But for the last couple of years, we've definitely paused while we ensure that, the organic growth of the business really helps us move forward.
And can you walk us through maybe like your thought process towards like an acquisition?
Yeah.
Like, are you looking for like new revenue, like less churn? Like, how exactly do you think of it?
So in the first example was that experience. That's what we were looking for. Of course, the revenue and all that, you need that, right? We're not going to buy a company just for the technology or just for the the team per se, right? There's got to be a revenue addition and value. Like, we were able to take the revenue of Nido and make that profitable, much like Maropost. So it's really just stacking, those same benefits or values that Maropost has on top of those businesses. Typically, we're looking for there to be a close connection again to what the Maropost vision is. So we wouldn't go out and purchase, as an example. Actually, we do inventory, so maybe we would. I guess we're looking for something within our sphere of technology. So we're not looking for something that like we're not going to do. So as an example, we may buy like a CDP type company because Maropost has a CDP or customer data, element to it. And so it's very easy for us to, literally transpose that data over, talk to the customers and be like, what are like 90% of the reports or that you really, really need, or analytics or metrics or so on, and then make sure that the Maropost side of things covers that. So we're looking for that coverage there in particular. Typically the other side is as you were saying, is the revenue and like the customer aspect. We want to look at the customer base and understand, okay, once that we've got them using our version of, whatever it is that we acquired, what is the likelihood that, 80% of these customers are going to buy 3 more of Maropost products under the Maropost single technology stack that we ourselves offer. And I think that's the other thing is like, we're not looking to buy the tech. Like that never really works. Like it works if you're Salesforce and you can spend $2 billion buying exact target and throw 2,000 engineers and be like, guys, like create a seamless or a reasonably seamless experience around it. But it doesn't really work otherwise. And I think that's why you don't typically see companies under 100 million making acquisitions. It doesn't work very well. And again, for us, like nothing that we've acquired, well, I shouldn't say that. Findify we did. Did we bring the technology into the Maropost platform? So Neato over time, someday won't be next week or certainly won't even be next year. But people will continue to log into Maropost, use Neato for certain things, and then over time we're just slicing off that technology, moving it over.
Okay, so if I understand correctly, like every time you make an acquisition, you're more in the buy or build type of mentality. Like you want something that has like adjacencies. That way, potentially you can have like more upsell.
Not even adjacencies. It has to be something that's in our own vision. So remember I was saying earlier that we were building e-commerce, marketing automation and help desk. That was again 10 years ago. Then it became marketing automation, help desk and e-com and then retail. So point of sale. And then we added search and merchandising, as I mentioned, which is really an offshoot feature of the e-commerce side of things. CDP as a product became natural for us because we had to build that. All the customer data is in Maropost in the first place. And then there's, I would say the seventh element is basically like the AI functionality that we actually designed also almost 10 years ago. And so where I'm going with that is like, if it doesn't fit within that sphere, right? If it's another thing, then no, we don't really want to get into that. And again, there's those subcategories, much like I mentioned search and merchandising, and I touched on inventory just as an example, or say order management or shipping plugins. Like some of that stuff can make sense because we are already doing exactly that.
And, how exactly do you get like the targets? Like, how do you find them? Do you have like bankers working for you, or you just
we did them all
or?
by ourselves, which is also
okay.
So we didn't have any representation. Of course, like we are, receiving inbounds, right? We're like naturally, bankers are looking for companies who have acquired businesses in the first place, which is not that big of a market to look at. So we have a lot coming our way, and of course we keep relationships going, and we have a lot of partners. I mean, no different than say a Shopify. We have they have tens of thousands, I think, if I'm not mistaken, but we have hundreds of tech partners. And a lot of times, we talk to those partners and we're like, you're kind of doing the same thing that we're doing here. Maybe again, it's in inventory or loyalty or something like that. And so there's an opportunity there for us to have that type of conversation. If they've been, again, running their business for 10 years and they're like, you know what, like this would fit much, much better under the Maropost, banner than it is me continuing to build out this sort of single function technology.
I remember like before I made actually my first acquisition and acquired like a business, I think we had like that chat and, it inspired me kind of to try to replicate. And I remember like one of the advice you gave, it was something in the lines of get ready, like for things to get pretty ugly, like when you do an acquisition and get ready for, the founders, like that of the company you acquire to sometime like do crazy things.
Yeah. Very.
Can you like maybe explain how you handled, like the NATO situation?
That was really hard because it was during COVID, number one. It was really difficult as well because it was in Australia, which is just far away from pretty much everything. So like just time zone wise is challenging. When I think when I originally had more exposure to Australia from a business perspective, I thought that, and this could be related to like North and South, right? I think if you're working with people in Sydney and Melbourne, that's probably more like a Toronto or Paris in the context of, of the more rural aspects. Maybe not rural is the wrong question, but I think that from a culture perspective, it was just a big difference. Nito was a very young company. Like their average age of their employees was, I think, like 25 or something like that, whereas Maropost was more like 35 or even 40 for that matter. So I think those areas create a pretty significant challenge. The other thing as well is that, with Canada, Australia, the UK, right, you think of the sort of British Commonwealth. I always had this assumption, and I was probably somewhat incorrect in that regard, that we were very similar. And we're actually not. Like, I think Canada is so close to the US that, from a business perspective, we still have this very, capitalist or business centric approach, from a growth standpoint or the contribution we make. And it's not that people worked really, really hard, but they were much more similar actually to Swedes, in my opinion, or in my experience. So that's been kind of the core element from that standpoint, that made it difficult. And so in terms of just handling it, it was really hard. The founder, he worked really hard as well. He really tried to bring the team along and really tried to focus on the pros of what it was, but ultimately they had built just a totally different culture than the one that we had and the one that we wanted to maintain. And I think if I could say one thing, it's that I would be and will be much more strict on the alignment with the business. So it's like, if you're not aligned with the business, feel free to exit the business or early on. I'd have a much stricter, stronger approach to where we would position people from an acquisition within the Maropost business. As in, it doesn't matter who I talk to whenever they've made an acquisition. If they put anybody from the acquisition on their executive team, it typically goes sideways. I think that the founders, right, it's like they're either going into some type of product or sales related aspect, right? Either they're still really good at selling their product or they're still really good at designing. And so those are the best areas. So those were some of like the strong learning lessons. Like, don't sacrifice your own culture, or don't sacrifice your own value. Not values, maybe is the wrong way of putting it, but principles maybe is a good term to use there. For the benefit of this team, because they're not your team. You bought them, and that's a totally different piece. And actually, it reminds me of one last thing that I continually reminded myself with after the fact. Like, when you make an acquisition, typically, right, it's a smaller company, right? So I think Nito was like 10 million in revenue and Maropost was like 40 million in revenue. So we're asking people with a different level of experience from a size and a scale and expectation standpoint, to mature in like 3 months, right? Which took us 10 years to get to in the first place. So I think that's a really important factor for people to consider. And I don't think they do. And again, that's why I think most acquisitions are seen as failures, or they blow up, or the founders leave pretty quickly and so on.
And how did you structure the deal? Like, was it all cash, or was it like also with an earnout based on milestone? Like,
yeah, Nito was a really unique one because the company was mostly owned by a company called Telstra, which is the largest telco in Australia. And so it was, which, like, if you knew them well, I mean, I don't know who the main telco is in France as an example, but it'd be like AT&T in the US, buying a small SaaS company, like that has nothing to do with their business. But what Telstra was trying to do was to build up this network of SaaS companies that would somehow benefit their customers. Again, I don't really understand it. Anyway, long story short, they figured out that wasn't going to work, obviously. And then they started, kind of exiting these businesses. So It was mostly cash because there was no opportunity outside of the founders to join the cap table or anything like that. We weren't going to bring Telstra into Maropost, and not that I think they would have wanted that. And then from an earnout perspective, we did have one, but it was small and it wasn't really relevant because like we knew what we were buying and we were just like, we'll kind of like we'll take it as is, if that makes sense. Yeah.
And what was your plan when it comes to the whole team? Because like if I'm putting myself in your shoes, you have like a extremely highly profitable business. You're making like 50 to 70% EBITDA margin, which is like insane. So you have cash to acquire businesses. But then, like you look at the business metrics and obviously they're not as profitable as you are, or like it's not likely. So essentially you're like, okay, I want to maybe change my cost structure. So potentially like the first step to change the cost structure is to let go some people, especially because when you merge, some functions are not helpful anymore. But how exactly do you see it from a people perspective? And maybe you can walk us through, like how big was your team when you acquired them and how it ended basically?
Yeah, I think a lot of the team stayed in place for quite, like, of course, there's the administrative roles, right? HR, finance, some of those areas that, are relatively or typically immediately taken over or merged into the main organization. But I think where I would go with that is those were part of the mistakes that we made. We allowed, certain people to stay too long. We allowed certain systems to run in unison for too long. Those things we should have moved much quicker on. But I think they were around 100 people when we acquired them. And then within maybe a year it was still 80. It was maybe a little bit more than 100 actually, now that I think about it. So it was probably like, 20 or 30 people that, either self-selected out because it wasn't for them or we exited because there was a redundancy that was occurring there. Again, going back to what I would have done differently is I would have had a much stronger plan or strategy to manage that on like arguably like a week over week or definitely a month over month basis, meaning like this is when, this group of people are going to be exited, or this is when we're going to move off of this technology, or this is when this is going to merge. We were definitely operating more in like the Wild West method of acquisitions when we did the first one. Like I said, it was me and we had a junior director of finance. Me and him did the acquisition together. He handled the integration or the financials aspect of it all. That is not normal. I mean, it's actually the opposite of normal, I think. But again, we learned a lot going through it, and for better or for worse, like I would do that acquisition again. And I think that's
because you learned a lot. Yeah, and for retail, sorry.
No, I was just gonna say, not just for the learning though. It was also because it was the right acquisition for us to make.
Like, financially it made sense.
Yeah, financially.
And for Retail Express, did you have like a proper plan in place? Like
no, still no plan.
No, still no plan.
Okay. No plan, because that one, like I said, that year after Nito was extremely difficult, and we were just like arguably, desperately trying to just stabilize the Nito business, with some mature leadership at least in place. So that was more of the goal there. Yeah.
On our side, the first company we acquired, I think it was a lot smaller, so around like 1 or 2 million in revenue. So it was like much smaller team. But I remembered like what you said, and I was I tried to be like careful with everything. But it's
Go ahead. Sorry.
No. I was saying like I think it's always tricky, as you mentioned, because you mentioned like processes, like the tech that you're using, what tech stack, everything. Like it's doing integration. Like if it's not on the same tech stack and you want something that's working well, it doesn't work. Because you mentioned like Salesforce making acquisition and being able to have 2,000 engineers. Even with that, to be honest, like we see it like. There are very little acquisition in the SaaS world that actually work really, really well. Like it's very tricky.
For sure. Yeah, absolutely. Mm-hmm. Absolutely. And when you were talking about the 1 to 2 million, so Findify we acquired out of Sweden was about 2 million in revenue. And I would never do a small acquisition like that again. It's just not worth the headache, because to be honest with you, it's the same amount of work. 20 million in revenue or 2 million or 50 million even of revenue. It's the same amount of work, the same amount of stress. You're still dealing with like teams and founders and cultural issues and so on. So it's like, if you're going to do it, make it count.
Yeah, I feel like this is I've got the same thing with the different real estate investment I made. When you have to renovate like a tiny whatever
totally
apartment
accurate.
and have people to like rent it out, it's the exact same shit as if you have like
a
a 500 or exactly.
I had a bunch of residential real estate units in Toronto, and I ended up selling them all because I was like, this is so much work. It's like, why don't you just buy one massive building instead of like 5 small ones?
I feel this is like the biggest like issue for a SaaS founder, because because we work so much on the computer and we make like a lot of money with like high margins. Eventually, when we want something that's like tangible, and real estate is like pretty nice. But eventually you get into real estate and you look at the margin, you look at the time, and you're like, I mean, I like it, but at the same time, it feels like the toxic relationship.
Job, it's a different job than the job you already have.
Yeah, exactly. And when it comes to like the structure, just going back a little bit on this, because I know you had like obviously like a super high EBITDA margin, but were you paying out of like your own like pocket in a sense with the company's money, or did you take like leverage and get some debt from the bank?
We did a little bit of debt for the first acquisitions, for the Retail Express and the Neato one. The other one was obviously much smaller. We took about 30 million in debt, but I'm very anti-debt. Like obviously there's scenarios where it's beneficial, but from a business perspective, meaning like on the Maropost side, I'm not keen on that, because something can happen, right? The market changes. Who knows? Maybe you have too much churn in one year. All of a sudden you have a real problem on your hands. So we try to, limit our debt as much as humanly possible. And frankly, it's more about managing that profitability that we've been discussing, throughout or even previously, to the benefit of those debt loads. So use the free cash flow we have, to be invested elsewhere, to then generate another return, then use that return to pay off the interest that, we have on the debt, if that makes sense.
Yeah, of course. And because you mentioned very quickly, like, when things go bad and your churn might increase, et cetera, like what's like the 1 or 2 metrics that you really like obsess over for your business?
Revenue and profit.
Okay.
I mean, at the end of the day, those are the two, top and bottom. Like, and when I say profit too, I'm not talking about EBITDA. Like I look at before tax free cash flow in particular, typically because of the acquisition, sort of mindset that we want to have, how we can acquire a business and have that decrease, via the expensable amounts of the acquisition, is extremely beneficial. But at the end of the day, it's like everything else in between to me is just like, it's noise. It's like, did our revenue grow? Yes. Did our profitability grow? Yes. Did it not? Why? And let's just look at it from those kind of specifics. But I mean, of course, we have like hundreds of metrics that we look at, and we are at the same time, or I am definitely trying to simplify that, so it becomes more like, I don't know if you've used Bear Metrics before as an example, or there's like Profit Well. I think there's a whole bunch of them nowadays. One of the regrets that I have is I didn't put those types of platforms or groups of metrics in place sooner. I think that if you're really strong on the sales side of things, which Maropost has been historically, this kind of like self-serve element and how, the subscription management side of things works with regards to, again, those platforms really helps you understand the nuances of any change, right? We lost this customer, we added this one upgraded, this one downgraded. You start to become, I think, a bit obsessed with that. And I think that's what's needed, frankly.
Yeah, and it's great. I mean, I personally use like Profitwell, and I think like Patrick did an awesome job. And receiving, like this email where it says like, hey, you're like 5% ahead of the goal, 6% ahead.
Yeah, exactly.
Like, every day, you know where you're at. Yeah. It's, I think.
Yeah, go ahead. Sorry, I'm excited.
Yeah, I think they really created something that's, that you want to check out. Like I check Profitwell, like even though I'm not involved in the day-to-day anymore, like I still check Profitwell like weekly or daily, like
but your business is mostly self-service, correct?
Yeah, it's mostly self-service.
Yeah. So that's where we were shifting from 100% direct sale to just now, like literally just now, January 2026, after again many years, opening up the self-service side. And to me, that's the most exciting, because like there's no question that we can sell our platform, or that our platform is amazing from a direct sale perspective. I want people who can just come in, like you said, add a plan, go from free trial to cancel, like without ever having to speak to somebody, as a second element, of course, to the business as well.
Yeah, I think for me that was like probably because by trade I'm like a chemical engineer, and then I studied like marketing and ended up like doing a SaaS. But the first time, like because prior to the SaaS I had like an agency, and it was similar. Like if I wanted to get money from someone, I would need 1, 2, 3, 4 meetings, do the work, etc. But the first time we received like that notification from Stripe about like a customer that I had never heard of. I didn't know who they were, like where they were coming from. It's just like magical. You're like, okay, like this is a new world.
Exactly. Nice. I'm really excited for that for us.
Yeah, I'm excited for you too, because it's awesome. And what are like the few projects you're excited about in the coming years?
To be honest with you, we're not going so far out to past the next 6 months. I think that's been a bit of a challenge, as I said, in our entire conversation that we've had over the last 10 years at Maropost in terms of getting products out to market. In the last 6 months, we launched our new commerce solution. We launched our help desk solution. We are launching self-service, as we mentioned, this month. We launched our AI solution. So there's a pretty significant amount that's happening, in real time. We've got a new head of product, and he's just doing an amazing job at, continuing that momentum. And sort of I'm going with this is I think that a big part, or I genuinely believe a big part of that momentum is because you've shortened the time frame. I think that of course, we should have as founders, we should have a 10-year, kind of vision for the business in terms of those core elements. But from a delivery perspective, it has to be that short amount of time, because otherwise people just start thinking in years, or that something could take years. And you're like, that's not going to take years. That should take like 2 weeks. You know what I mean? Let's get back to like, and that's when we started, of course. I think it's very similar everywhere. It's like we were updating the code every day, and then every day turns into once a week, and then it turns into every 2 weeks. And then all of a sudden you're like, how often are we actually excited about the business and what we're putting out there when it's so extended in terms of the time frame?
100% agree that creating urgency as you scale is something that is quite hard. And I think, was it like a Parkinson's law or something? Like a task take as much time as you actually like allocate a certain amount of time or whatever. But it's pretty much
what do you mean?
It's like essentially like if you tell someone that they have like 1 day to do something, they would do it in 1 day. But if you tell them that they have like a week,
whatever
or two,
they decide,
exactly. Like they can also spend that amount of time. So it's always like
for sure. It's
kind of your role to decide on the exactly.
If you have low expectations, you're going to get low results. If you have high expectations, you may not get the expectations you want. They're still going to be a heck of a lot higher than they were. That I would say that's kind of a funny point, because a significant amount of our challenges as well, over more so maybe the last 5 years, have related to that mindset and distilling that mindset through the rest of the company, right? It's like it comes down, at the start of the conversation, we were talking about, kind of the young and hungry, executives or up and coming executives that you want to have running your business, versus say the people who are sort of, half retired. That's a really core element of it, right? They are worn down in their life, so they have low expectations of their own team, versus the guy coming in, 30 years old, he's like, I have 10 things I want to accomplish today. Like I work on a daily, kind of to what you were just saying. Like I work per day. I wake up and I'm like, what do I want to achieve today? Not this week, not this month, definitely not this quarter. And I think that again, as an industry, we've gotten into that longer time cycle or time frame.
Yeah, definitely. And I know we're almost running out of time, so that'll be the last question. What's like one advice you wish you had received when you basically like started Maropost?
Yeah, spend a lot more time on recruiting.
Okay.
Spend a lot more time. Yeah, not only a lot more time on recruiting, a lot more time understanding the type of person that you need to work here, and really leveraging, outside parties who do have that experience. Like the way I interview people now, or the way I have, conversations with executives that we're hiring, as an example, is completely different than it was 3 years ago. And, I would take that back 10 years ago, frankly. I think that, I think I can only speak for myself, but, I rely a lot on what people say, right? And if they're like, this is what I built here, but what, we unfortunately just do live in the world where, people aren't always completely honest, and they're definitely not as honest as we would expect in the interview process. So I'm sure you've interviewed people and, they're like, you're thinking this person's going to make all my dreams come true. And then within the first month, you're like, maybe I wasn't.
There is no messiah.
Yeah, exactly. Well, no, but it usually comes down to what your expectations were, going back to that same comment. So I think that recruitment aspect is something that I wish I had spent a lot more time, meaning maturing from that standpoint as well, and also leveraging outside resources specifically for that.
Awesome. Where can people follow you?
Yeah, I mean, LinkedIn, Instagram. Yeah.
Awesome.
Yeah,
we'll put the link in the comments.
If you want to see me just floating around in the sea, or you want to hear what I have to say about, the next stages of e-commerce and retail. Yeah.
Awesome. Thanks a lot for your time and all the knowledge you shared.
Same to you. Really appreciate it.
Day.
You too.